see into the future. But we don't know what's going to happen over the next 12 months with kind of their printing and all that kind of stuff.
Well, one of their options was to taper interest rates, right? And they did that to such an extent, and then they're like, look, we can't, like, what else can we do? And that result is, let's print more money.
They went to zero, 2 emergency rate cuts. And there's an individual that I had dinner with at one point, and right before they did the 2 emergency rate cuts, I was like, oh yeah, they're going to bring rates to zero. This guy works on Wall Street. And he was like,
they'll never do that.
He literally was like laughing at me. He was like, no way. And then they did 2 emergency rate cuts.
You text him?
In the next like 14 days, and they cut it down. Nah, but he knows. I didn't need to rub it in, but he knew. And when you think about going interest rate zero, they print all this money and they just manipulate the economy. And then you look at all of the economic data that they're reporting today. We know it's all inaccurate. It's like, look, this is just a game. The debt doesn't matter. What they're doing doesn't actually matter because everyone already knows the charade. And so now what we're watching is people are just trying to figure out if they're going to continue doing what they're doing. How do I play?
Will they let a market crash happen? Or are they just going to literally step in and say, there's no way we're going to let that happen. Let's print money. Let's do all these other things.
One of the most important things that has occurred in recent financial markets is that the market crashes are not about finance anymore. It's not about investing anymore. We have completely removed risk-taking from the market. So if you're in the market long enough, they've removed all risk. There is no risk investing in the stock market. They will not let the stock market go down for a long period of time. And so when you remove the risk from the market, what that means is people start to take even crazier and crazier bets. So you get more leverage in the system. They push further and further out on the risk curve, et cetera. But there is no risk. And so when investors figured that out, they started to throw money all over the place. Look at the boom of SPACs and all this other stuff that people are pointing at, like, man, this seems kind of crazy. There's no risk in the market because every time it starts to look like it's going to turn over, they actually come in and they manipulate the market higher and higher. Now, at some point, you can't keep doing that, or you're going to completely ruin the currency or have other kind of tertiary negative impact. But what does change is the psychology of the investor. And so people who have been rational and have said, oh my God, the valuation multiples of these assets are really high, or this is crazy. Why is that company being funded? Or how is that company still trading at such a high kind of market cap? It's because the thing that has changed is not the market, but the manipulation of the market. Since 2008, 2009, value investors have absolutely suffered because they've been trying to be rational in an irrational market. And so when you remove risk, people push further and further out on those crazy bets. And so I don't think that they're going to let the market crash because it's not now about, oh, investors lost their money. It's now a social issue. The second that the market starts to go down, immediately every capitalist, allegedly, on Wall Street turns into a socialist and they run to the government. The airlines literally couldn't have made a faster beeline to the government during the pandemic, begging for cash. And the government was the suckers in the room, and they gave them billions of dollars, about 2/3 of it completely for free. And so when you think about this reinforcement mechanism of every time that there is some sort of crisis or there's some sort of market correction, everyone just turns and runs to the government and says, print more, manipulate interest rates more, give me free money. And then we do it. You train the market to believe that you're always going to do it. So could they at some point decide not to do it? Sure. But if history is an indicator of the future, then they're going to keep stepping in the market. And so there's no risk anymore in investing in the public markets. And when you remove that risk, people do crazy shit. And that's what we're seeing in the market today.
So how long do you think it took for the S&P to get back to where it was right before, I guess, the crash in February of last year?
So from February 2020, the crash and then back?
Yeah.
45 days.
No, 6 months.
It took 6 months.
Give them a little credit. How long do you think it?
6 months? You think that's giving them credit?
Well, how long do you think it took for 2007 for it to get back to where it was?
3 years.
Yeah, it took like 5 years.
5 years.
Yeah.
Okay.
From 2007 to like around 2013 it took. So
so we basically made it
quicker,
1/10. Yeah, we basically made the recovery 1/10 of the time frame.
And the collapse was a little different. It was like structurally different, right? But they realized how to do it, and they're like, let's put the gas pedal on.
You know what's better than $1 billion? $1 trillion, baby. I mean, that's what they did, right? Is they literally, the second that it started, the immediate conversation went to cut rates, 2 emergency cuts, and let's just get a bazooka from a monetary and fiscal standpoint, and let's just drop it on the market. And they did that, and the market did recover. But talking about now, the people that suffer are the people who don't own assets because it drastically devalues the currency. And so rich people got richer, poor got poor. And so if you actually want to close the wealth inequality gap, it was the wrong thing to do. If you want to mitigate short-term pain, it did. Like there are some positive impact of what they did. Mitigated short-term pain at the expense of the long-term impact. And that's ultimately where the disagreement is. How important is the long-term impact versus the short-term impact? And is there an in-between that you should try to serve?
I like that analogy you guys were talking about a few weeks ago of like kick the can down the road. And it was just like, hey, well, I'm like,
is that a new one for you?
What? Nah, I've heard of it before. But it was interesting in this aspect is basically like let the next guy deal with it. Let the next generation deal with it, right? And we've notoriously done that throughout the history of the United States.
Currency is not real.
Currency is not real.
True.
Sound money.
True. Speaking of not real, smash the like button. This is going to be a good one.
Like button's real.
Oh, yeah. Hey, listen, we still have these shirts up there. If you want these shirts, you could definitely go get them, bestbusinessshow.com.
Not looking like it's going to stop anytime soon.
Yeah, you may be wearing that for a while. It's not going out of style.
We may keep those shirts on the site until they stop printing, so they'll be there forever. All right. Evergrande is a huge story out of China that a lot of people aren't talking about yet. Evergrande is one of the most important assets in the Chinese economy, and it looks like it is imploding before our eyes. So you could say that the headline here is Evergrande screwed a bunch of people in China, literally. After expanding very rapidly for years, this company has been snapping up assets in the Chinese economy. The Evergrande business is now suffering under an absolute immense amount of debt, about $300 billion worth of debt. And so let's start with what is Evergrande, this China Evergrande business. They own about 1,300 real estate projects in over 280 cities in China. Its property service management arm is involved in nearly 2,800 projects across more than 310 cities in China. So they own a bunch of real estate projects, and they also have a property management arm for a bunch of projects as well. The company has 7 units dabbling in a wide range of industries, including electric vehicles, healthcare services, consumer products, video and television production units, and even a theme park. They say that they have over 200,000 employees, but indirectly more than 3.8 million jobs every year. Great research by our outsourced partner, Bloomberg. Evergrande was the country's largest high-yield dollar bond issuer. The largest issuer. 16% of all outstanding notes in China came from this one company. And now that they have been forced, because of the structural issues, to delay payments on up to 40 billion won in wealth management products, there are now protests across the country where all these people are coming and saying, hey, I rely on you for income. I rely on you because you have a material percent of my portfolio. Give me my money back. Give me my yield payment. And the company is saying, we can't do that right now. It's a very, very big story. And so we've got 2 quotes here. The first comes from Mark Williams, the chief Asia economist at Capital Economics. He said Evergrande's collapse would be the biggest test that China's financial system has faced in years. And then we've got Dan Wang from the economist at Hong Seng Bank. Evergrande is such an important real estate developer, and it would be a strong signal if anything happened to it. I believe there will be some supporting measures from the central government or even the central bank trying to bail out Evergrande. Now, as we know, in 2008, 2009, the U.S. government determined some financial institutions to be too big to fail, and they stepped in and they saved them. They propped them up. They prevented collapse of the system. Probably was a pretty good decision, but a lot of people were unhappy about the way that it occurred. And so when you think about this, the Chinese economy is massive. The Chinese financial system is massive. This is their equivalent. One of, if not the largest player with over $300 billion of debt is in trouble. And we don't yet know, is the government or the central bank going to step in and determine them too big to fail? Investors, though, ain't very happy. We've got the stock price here. As you can imagine, it's going down. probably not going down nearly as fast as you would think it was going down. But the year-to-date move is significant. It's lost over 60% of its value, and it looks like it's headed to zero. Now, if the government steps in and saves it, it won't go to zero. If the government doesn't step in and save it, it won't go to zero. Now, the shareholder wipeout, Evergrande stock, is down 90% from the 2020 high. And as you can see here, the Hang Seng